Everybody's talking about bear markets right now, mainly because I think everybody's admitting to the fact that we're currently in a bear market. The problem is that the precedent that most people think about is the 2020 bear market. And it was a very deep decline. It was a very difficult decline, but it happened in a very short amount of time. And for new traders that are expecting the bear market to end quickly because of that precedent in their minds, they're looking for the bottom way too soon, because bear markets are typically not going to be what we saw in 2020 and COVID crisis. It was a much different situation. But those of us who've lived through bear markets, quite a few, know that that is not the typical kind of bear market that we normally would experience. Today we're going to examine three bear markets in particular. We're going to look at the savings and loan from 1987, 1989, and what happened with that crash. We're going to talk about the dot-com crash back in the late 90s, 2000, and then we're going to look at the housing crisis and that particular bear market. At this point, we really have to realize, and most traders need to realize, especially those new to trading, that bear markets are usually a long-lasting affair, and the market doesn't always go up.
These are all the factors that are considered part of the reason why the market crashed in 1987. Now, what's interesting, I do want to say, is there is not widespread agreement across the board. However, there are 4 or 5 factors that did contribute to it. One was the fact that the market was extremely frothy in 1987. From the beginning of the year to mid-October, things were up over 40%. So it was basically a correction of an extremely frothy market. Number 2, interest rates started moving up as well. So higher rates definitely sucked money out of the market. The other thing that is also interesting is that program trading really contributed to a lot. So this was in the early days of stock market futures, and those futures were clearly used to hedge a declining market. And as the market declined more hedges came in, selling the futures, contributing to the waterfall effect on the downside. So that was a big factor. And because it was sort of the infancy of the futures markets and different settlements, it also got a bit confusing as to how all these futures contracts settled. So that had to be cleared up as well. But that was also part of the contributing factor. The other thing is that our Treasury Secretary at the time, Baker, also put out some pretty controversial statements about the dollar, and that contributed to the decline as well. At the time, the public sentiment was quite a bit of shock. Alan Greenspan was the new head of the Federal Reserve. And what he did is he loosened rates, and basically the whole idea of the Federal Reserve basically being an instrument to support the markets under stress started with that 1987 crash in a big way. That was called the Plunge Protection Team. And I think where we are now has really been an extension of that and a distortion of that to a large degree. But it started because obviously the government had to step in to stabilize the markets. Now, remember, initially, the Federal Reserve came in there to stop the decline and add liquidity. And it's sort of been distorted now, where the separation of the Federal Reserve from the stock market and keeping prices high is something that really has been an outgrowth over the last 40 years or so. Well, actually, I was running money, some of my own and individual clients. And at the time, I actually was had offices adjacent, sort of sharing offices with Ray Dalio, who at the time I think maybe had 10 or 15 people at his company. So we were sharing offices in or similar facilities in Connecticut. So I would get his research reports. And of course, with the rise in rates, he was getting pretty negative. So I had some pretty good information. And I also was very big in trading options. And I had some very large option positions on. Actually, I had straddles because I believed that the volatility in the market was really high and options were mispriced. So I had my best day trading ever in 1987, the day of the crash. The savings and loan crisis lasted probably about 10 years before it culminated in 1989, along with Charles Keating and his savings and loan and American Continental Homes actually going bankrupt. So I think the net loss just from Keating's enterprises was $3.4 billion, which in those days was actual real money. The regulatory laws around savings and loan got switched. They had pretty much carte blanche, where they were depending on deposits to fund long-term loans. And when they didn't get enough deposits, they were basically in default or had negative net worth that the FDIC had to guarantee. So a lot of that has been corrected with the new banking laws and exactly what savings and loan organizations are allowed to do. So there's been a major shift in that across the board. But it took 10 years for it to culminate, basically, in 1989.
So the first signs that a bear market was starting really could point to Japan, because Japan actually had entered a recession in March of 2000, and it was right timed with the peak of the dot-com situation, and might have been one of the contributing factors to why all of a sudden things were going to really unravel quickly. And also, Greenspan, who was the Fed chairman at the time, had a very easy monetary supply kind of stance, started out hawkish, but wound up very, very dovish. And so that's another reason, is that it was also fueling with very low interest rates. And also, what was really becoming obvious was that employment numbers were starting to shift, because unemployment went from 4% in early 2000 to 6% by the time 2003. And that, well, of course, was another indication of GDP, which also started to crash from 4.75% at its peak to 1%. So all of these situations really started to emerging, where it became obvious that the NASDAQ, and we can show you a chart, was overbloated and was ready to start failing. On top of that, you had most companies washed out during that time. And of course, the couple that did survive would be Amazon and Microsoft. So since we like to make everything visual, let's take a look at this chart, because this chart shows in 2000, the climb up before the peak, as I had mentioned in March in NASDAQ, the ultimate crash. And then even though we had a couple of rallies along the way, we really stayed in that bear market until we started to climb out of it in October of 2002. Now, what's so interesting is if we look at the current situation, again, we had almost a tech bubble with overvaluations and huge corporate buybacks and everybody piling into the tech space. And then as we've gotten into 2022 with higher interest rates and just some other areas of inflation really impacting the market, once again, we saw a little bit of a rally, and now we're coming off again. So if we look at this in terms of time, this is just a year and a half, not even, maybe more like a year. So that means that in this situation, since we can't go to zero rates, because that's the reason why we're here now, the question you have to ask yourself for this current bear market is, if it's unlike the dot-com bubble or the 2008 bubble, because the Fed can't come in and save the day, how long can this bear market last? And it could definitely take quite a long time. So personally, as far as trading was going at that particular time, since Keith and I and Jeff, all the principles of market gauge, were primarily commodities traders, we were actually relatively quiet during that time because commodities had kind of peaked at that point after the whole Persian Gulf War in the 1990s. And so we weren't doing that much trading. Actually, what we were doing was creating tools for institutional investors that would help them with their trading. And so we had contracts with many institutional investors before the dot-com bubble that they were going to go buy our stuff, our particular trading tools. And then most of those companies either went belly up with the dot-com bubble, or they actually lost the staff that were working with us and had contracts with us. And that actually, interestingly enough, although it kind of killed the whole idea of market gauge getting involved with the institutional investor, was really kind of what brought us around to the retail investor and then got us back into the markets once the dot-com bubble had seen its worst wreckage. Well, the public sentiment before the actual bubble was that money was easy. And we certainly know that in recent periods of time, we can draw parallels to that where it seems like money is easy. And of course, that's not what we're experiencing now. But the other more unfortunate aspect of the public sentiment was that fortunes were wiped out. I know people personally who had all their money tied up in tech and did not get out with the warning signs and lost hundreds of thousands of dollars. So there was a real shock, not only financially, which led to that very brief recession that we had till it finally came out of it in 2003, but it also really gave people a shock in terms of just what they were really expecting from the market. And those who actually survived it became much smarter traders as a result. But it's an incredible case of herd mentality. And when everything gets really geared towards one side, that you have to start looking for the warning signs that things are too good to be true. Generally, it's because they are. So the market corrected itself by, number one, the Fed actually kept interest rates low and famously went to zero after September 9/11, actually, the attacks to try to spur the economic activity and growth. So you really had two things going on. You had the dot-com bubble, and then, of course, you had the terror attack. It took really several years for the market to recover, and many stocks really never recovered, like Pets.com, for example, was a famous company that went bankrupt during that time. But really, it took the tech stocks another 5 to 15 years really to be able to go beyond the highs that were made before the dot-com bubble. And really, it was the low interest rates, once again, that helped feed the next great asset price bubble, of course, which was the mortgage debacle in 2008. And really, in terms of just the NASDAQ itself, it had peaked in March 24th of 2000, and then ultimately bottomed out in October of 2002. So it was about a 2-year cycle. But it really did not recover in terms of the market until about the mid-2000s, when things started not only with zero interest rates helped propel the economy, but the housing market started experiencing a boom, and people started feeling rich from the housing market and from real estate, which of course we know was from very fraudulent lending and a false sense of security, which of course then led to the 2008 bubble. But really, it took a good solid 5 to 6 years to really work our way out of the impact of that dot-com bubble.
The bear market and the housing crisis got started in October of 2007. Some of the first signs that we knew that we were getting ready to at least have a downturn in the market was certainly public sentiment was way too bullish. That's always a problem. And, there were a lot of underneath the surface problems, obviously, with the mortgages. So we were already seeing those kind of signs overall, that things were out of whack, if you will. And Carl and I were noticing at that point that we were starting to see those negative divergences coming into play. And then the fact that sentiment started to turn a little bit, as the crisis kind of continued on. And so we knew based on indicators that things weren't looking so good. And we were prepared for that to some degree, but I think none of us are fully prepared for dealing with a bear market because there's still a lot of unknowns when you're going through it. So, it was pretty stressful to be an analyst during that time for a number of reasons. I would say number one is people didn't want to hear about the fact that the market was going to continue lower. And as technicians, that's what we were having to tell people, that it was ugly, it was going to get more ugly. And people don't like to hear bad news. So it made it very hard to get, people to listen to what's going on because they just keep thinking it's going to be over tomorrow. And having lived through prior bear markets, we knew that typically that's not going to be the case. It might last a bit longer. So it was very hard as an analyst, mainly because we had to continue to give them bad news, and people don't want to hear bad news. And so, subscribers kind of drop off a little bit. It's very hard when people just don't, they want to hear that things are going to turn around. And honestly, the analysts who were willing to be optimistic were actually, getting a little bit more coverage just because, hey, we don't want to hear the bad news. So that was probably one of the more difficult things to do and live with during that period of time. And of course, we all had our own mortgages. We all had most of us had our own homes. So we were having to deal with that, profit loss on our own side and worrying about people, having houses that were now quote unquote upside down, where your mortgage is higher than what your house is worth. It was a very dicey time. So I think really the moment we started to get out of this was, of course, public sentiment was extraordinarily bearish. Housing prices had really tanked. And, once things got more to equilibrium as to where they should have been economically, as far as those mortgages, that really was when we started to see that market bottom. But we also were seeing those confirmations from our indicators to tell us that, all right, now we can be on the lookout for a change in direction for the overall market in the longer term. The bear market for the housing crisis, if you will, started basically in October of 2007. After about 16 to 17 months, we finally hit the trough, the low for that bear market. And that was after the market had lost over 50%. So it was painful. It was extraordinarily painful. And because it was so painful, even after it recovered, as far as the trough coming out of that bear market, we didn't actually hit the top that we were out in 2007 until 2012. So the recovery took an extraordinarily long time to get there. But at least that was a time of rising prices, so that there was at least some profits to be had out there. But the point is that the bear market can last a while, and it can take a really long time before you finally recover from it.
So I was taught that history doesn't repeat itself, but it often rhymes. And I think you find a lot of similarities with where we're at now in 2022 versus previous bear market cycles. When you think about where we're at and how the sort of the current market has started to rotate, the bear market is caused by sort of the end of the previous bull market, right? Sort of the conditions that allow the market to get to where it did is usually what begins begins the end, I guess, right? Begins the beginning of the bear market phase that comes next. So as 2022 has sold off, the conditions really were driven by what happened in the 2000 teens, right? So 2009 market bottom after the financial crisis. You had this big run up from 2009 to 2020. Then the COVID-19 pandemic hits and everything sort of changes. You have economic conditions starting to shift as, obviously everyone's trying to figure out sort of unknown circumstances for a lot, what the impact will be on consumer behavior, and really our way of life was unknown. And that causes a lot of instability. The Federal Reserve and a lot of, economic forces had to be put into play to make sure that the economy and that consumer behavior, that the human beings in general were going to be able to recover during this period. Therefore, you had this great run in 2020 into 2021, which was the emerging technology, sort of the work from home stocks doing so well, and the FANG stocks continuing to emerge in a position of strength. 2022 all of a sudden starts to change. The Federal Reserve's impulse or their aggressive action to help the economy recover really set the stages for where we're at now, which is inflationary pressures start to really get out of hand. And as a result, the Fed has to start to take aggressive action to address runaway inflation. That leads to the bear market phase in 2022. I really enjoy bear markets, which is kind of a twisted answer to what it's like to be investing in a bear market or be a technical analyst in a bear market. I started in the industry in 2000, so I've seen a number of bear market phases. And while bull markets are great when everything's going up and everyone's happy because everything's working, they're boring, to be honest with you. Everything's easy. I was taught, don't confuse brains with a bull market. We get super overconfident and it's very easy to become complacent when everything's just kind of going up. Bear markets are where you have to actually work for things. This is where I've learned a ton. I was told that bear markets are your tuition to the market gods. This is where you pay your tuition as an investor, as a trader, and where you learn how to really invest well, because you have to focus on money management and capital preservation and position sizing and all of those things that make a successful trader in a lot of ways. So this environment sort of rotating from the bull market phase of the 2000 teens to sort of the bear market conditions that are more common in the 2020s, I find fascinatingly interesting. I think it's really interesting to compare where we're at to where we've been in previous bear market cycles. So I find there are a lot of questions. There's a lot of uncertainty and a lot of new investors that are struggling with how to navigate this sort of environment. And I find that to be, I feel like as technical analysts, we have a lot of opportunity to help empower people to make better decisions and unwind some of the poor decisions you're probably hardwired to make. In terms of the conditions, I feel like if you follow technical analysis and you follow charts, there are a lot of clear signs, particularly at the end of 2021 into 2022, that conditions were changing. Price, breadth, and sentiment, all three of those showed upside extremes in the end of 2021. All three of them rotated magnificently into 2022. So I think the evidence is there if you're open to paying attention to the evidence on the charts. So I think when you look at the course of 2020, 2021 to 2022, you've seen a clear rotation in sentiment. Bear market phases usually begin with a disbelief phase. There's that initial sell-off where people that had been buying on the dips on the way up, and 2021 was the buy on the dips year, right? The market would move to a new high, it would pull back, you buy on that dip and you ride it to new highs. And the game looking back was incredibly easy. When that starts to fail, you have the disbelief phase where the initial investors are trying to buy on the dips and it doesn't work. We make a lower high, which is what happened in sort of January, February, March in 2022. Then you begin to get into what we call the acceptance phase. People start to recognize that the conditions are getting worse. And that's where I think sentiment comes into play. If you look at things like the AAII survey, the end of 2021 is sort of 60% bullish. Now it's more 60% bearish, which doesn't seem like much, but that's a huge swing in sentiment from more than half the people being optimistic to more than half the people being pessimistic. It's actually pretty unusual. If you look at the spread between bulls and bears in a lot of investment surveys, the widest that they've been really in history, some of the most negative levels ever. The name exposure index, which tracks money managers, and how exposed they are to the equity space at long-term lows. I mean, some of the lowest levels that we've seen. So you've certainly seen a rotation lower. I think the best measure of sentiment is the price of major assets. Look at the FANG stocks, many of which are making new lows most months in 2022. You look at energy stocks, which had been making new highs earlier 2022, now starting to retest key support levels. And they've gone from being up 60, 70% to only being up 30%. Now, while still having a positive run, are pulling back quite a bit. The challenge with bear markets is that they tend to last a lot longer than we want. I was taught that the markets will move in whatever direction causes the most pain to the most people. And I think the pain trade is still down. I think still investors that are newer to the financial markets are going to be struggling with an extended bear market phase. If the economy does end up being in a recession, which I think it likely does, but bear markets tend to last a little longer than what we've seen so far in 2022. So all I would suggest is people to stay vigilant, focus on capital preservation, focus on raising cash. So if and when a bottom actually comes, you want to be able to reallocate into new opportunities. I think the evidence will show you when the bear market is over. Then you want to be ready to get back in at an optimal time.
So how long will this bear market last? Well, I certainly wish that I could tell you that, but I can tell you some of the signs and signals that we're looking for at Decision Point. First of all, we need to see capitulation. We need to see sentiment extraordinarily bearish. And right now, if you look on social media, that isn't the case. We still have plenty of people out there that are just sure that this is over. Maybe it is, but more than likely not. And I'll tell you why, because you need to start looking for your bullish signals to start resolving to the upside. And at Decision Point, positive divergences, bullish signals are not resolving with a market move to the upside. And that tells us that the bear market is continuing. So those are things to keep in mind. But one of the things that I often go back to is my dad, Erin Swenlin, came up with bear market rules, sort of guidelines to help you during this volatile time. So first of all, remember that overbought conditions in a bear market are extraordinarily dangerous. Bearish signals are almost always going to result in more downside. Oversold conditions, which we get excited about in a bull market, are now thin ice. You don't have a solid foundation for the price to continue to the upside and have those rallies be lasting. And then of course, I think as most are discovering, buying into a bear market is very, very dangerous, highly risky. You need to expect your bullish chart patterns to resolve to the downside, not to the upside. I love my chart patterns, and I've learned that I have to temper my expectations when I'm in a bear market. But the final and most important thing, there are no long-term positions. There are no buy and holds in a bear market. Every position should be managed in the short term. But don't lose hope. This is a really great opportunity for new traders in particular to learn from this experience. Just remember that if you are investing in this bear market right now, everything's short term. You need to have your hand on the wheel. If you don't have your hand on the wheel and you want to be out of the bear market right now, then it's your time to learn to drive.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.